Okay, that's really low. Okay. Let me do my, okay, start video. You'll be muted. Share audio from your computer. Sharing audio. No. Okay, good. Finally. I hope you can hear me. You can hear me?
Yes, ma'am, and I can see you.
So I am going to share. Okay, great. So I have a slide deck, so I'm going to share it. This is what I'm going to talk through today.
Okay.
So I'll just share that on the screen so everyone could see it. You could see the video?
Yeah, it's up.
Okay, great. So let's get it going for the class. Okay. So everyone could see that. Okay, so a couple of things I wanted to talk about before we start. Good morning. So the midterm exam, I got them last week. By next class, you should have them back. I just haven't gotten to grading them. Homework grades and remaining homework. So I posted the homework for the remaining chapters. So like I explained before, my focus is more on the theory and not so much for you to be able to do a statement, because I just feel like you got to be hardcore accounting to do all of that. So you'll see from the homework that I assigned, the homework is more focused on, okay, are there three methods? Why choose this method over the next method? And really knowing the theory behind the concepts. So that's why when you see what I posted in the Google class, and I also have it at the back of these slides, I'm gonna upload these slides at the end of class. It's focused on the questions from the chapter, and it might have one or two exercises, but those exercises are more conceptual. Then there's, is this an accounting change or not an accounting change? And we're going to do two of the questions in the chapter in class today, so we'll have some practice. Okay. So that's the homework for the last three chapters. I posted it, so you could make sure you read those chapters, make sure you do the questions, because the final exam is going to be weighted towards those final three chapters. Anything coming from the first part going to be like a little multiple choice, but the majority is going to be the last chapters. And I'm actually going to take the multiple choice from what you already had before, multiple choice you had before. How many people used the link that I had for the mock review? Yeah, was that helpful? Okay. So you could review that again if you want, because I'm going to take the questions from the previous part from that, and then the new questions are going to be weighted towards the final. So the final exam should be multiple choice. It's not going to be more than 50 multiple choice. And then the problem question is going to be like theory based. So like the advantages of this, or What's the difference between this versus that? So it's gonna be that type of question, okay? And you're probably gonna have 3 just because it's a final exam. 3 problems. So today, we're gonna focus on chapter 22 and 23. Next week is chapter 24, and then the following week is the final exam. So that's why I gave you all the homework now. So if you wanna read ahead, do it, knock yourself out, great. But the final exam will be the last Saturday in April. Now, in terms of homework and grades, so I explained at the beginning that I normally give, I don't really grade homework, yes, like right or wrong. I'm gonna upload solutions so you could review it to make sure you're on track. So you have like a self-review, but I review it to see how much of you completed, and I give credit for that. So if, say for a particular chapter, you did most of the homework, then I give it to you for it. If you didn't do any homework, then so I'll have say if I have 10 pieces of homework, because it's 10 chapters, how many chapters? I normally drop 1 because sometimes someone just missed. And then I give 1 point for completing it, and then 0 if you didn't do anything at all. If you did like half, then I give half, and then that's how I kind of come to the 10, right? So when you doing the review, it's good just to do it, because then uploaded, that's 10 points right there. And by next class, I will be able to tell you where you are at, like going into the final exam. So I don't know of any questions on that or concerns or anything.
Would you be able to tell us if there are outstanding assignments for us next
I could tell you that too. Yeah, I could tell you that too. So, so that's the path over the next 3 weeks. Well, 2 weeks, because today, next week, and then the final, right? So you could start looking at the final from now, right? So preparing. And if the mock was useful, I could give you questions again for the last 3 chapters. And then you could review that, right? Just multiple choice, so you could have some practice to see what that could be like, okay? So I'll probably do that for you as well. So today we are looking at accounting changes and error analysis, right? So in accounting world, or real world, nothing is perfect. Stuff happens. So you always want to know how to deal with errors, because they do occur. And then if you change accounting method, say you used one method to depreciate assets, you may change it along the way. And there are good reasons why you may need to change. Your company has changed, circumstances have changed. So you might need to change a method or a way of doing things. So we have rules around that when you want to change and how you should deal with a change. And so the aim of accounting is always we want comparability. We want to look at one period to another period to make sure we can compare the numbers, apples to apples, oranges to oranges. So we want to make sure that we don't obscure, like it says, useful historical trends. So the reader has an understanding. But we isolate changes into 3 categories: accounting principle, accounting estimate, and change in the report, the actual reporting entity. And the last thing, errors. They're not considered changes. So we deal with errors as errors. So the first 3, 1 to 3, there is a approach taken for each one in terms of how we deal with that type of change. I have at the end of this chapter is a nice little summary of all of them in a table so that you could see all of them lined up against each other. So the first one, the change in accounting principle, right? So here examples will be like if we change from average cost to LIFO for inventory valuation. If we change from completed contract to percentage of completion method to recognize revenue on construction projects. So what we are saying here is that we are, when we adopt a new principle, we treat it as these events almost like they occurred for the first time, or that anything that happened before, if we don't do anything, we're not doing anything to the previous information because we don't think the change is a material change. But when the change is significant, what we have three approaches in dealing with changes that are significant. So one is deal with it currently, so that in the current books, we make the change. And we only, so if we use, say, LIFO before, and now we go into average cost. So we change average cost in the current year, so that's current. Or we could do retrospectively, where we go back, we change the numbers we reported before, restate them. And then from going back, restating, then we bring it forward, right? Or we could do it prospectively, where we just change it in the future, like going forward. So there are the three approaches, but FASB requires the retrospective approach. So they actually require for a change in accounting principle that we go back, right? And again, the reason is comparability. Because if we just change the number today, and when you see financial statements, they normally have a comparative number. So we have to be in 20. So the last financial reporting year would have been 2022. So you'll see 21 and 22. If you made a change in 22 and you compare to 21, it's not going to make sense. So what they're saying, they want you to go back so that can make sense. So when you compare the two inventories, both of them on the same basis. Okay. So that's really the rationale why they say for change in accounting principle, we have to use the retrospective approach, okay? Now, the reason why 3 are mentioned is because sometimes you can't do that approach, and we'll discuss that, in the next few slides. But what does retrospective mean for accounting? So you adjust the financial statements for each prior period, presented to the same basis. So that's a lot. Also, you adjust the carrying amounts of assets and liabilities and the opening retained earnings. So that's significant that you have to go back. And companies do it because sometimes you need to do it for whatever the issue or thing that you wanted to change. But the reason, the other reason I believe that something like this is so onerous to discourage people from just willy-nilly, oh, I'm going to change this method to make my earnings look better, because people do that, right? So you're not going to just do that lightly if you got to go back to prior numbers and restate, because that's a lot of work. So when we have to do this change, our disclosure is very specific. We have to disclose the nature of the change in accounting principles. So normally there's actual note in the notes of the financial statements that highlights that there was a change in accounting principle. And what you disclose is the description of the prior period information that has been adjusted. So normally you'll see a table and it'll have the number before adjustment. It'll have the whatever the adjustment is to bring it to the new method, and then they have to restate it numbers. So they normally have a whole table. So that's what A, B, and C. So you have the prior period information, the effect of the change on income from continuing operations, net income, and any other affected line. So that's what the table would have. And then the cumulative effect of the change on retained earnings, okay? Because all your prior incomes that would have rolled into retained earnings would have now been changed, right? So your opening retained earnings has to be restated, okay? So all of that, although your actual financial, the numbers part of your financial statements, balance sheet, income statement, you'll have a column that says restated. You also have to do a note to explain how you got to those new numbers. So if I was a reader and I had the old financial statements, I should be able to take the old one, pull up the new one, and see how you got from old to the new. Yeah. So direct and indirect effects. So if you change something, if there's a change in principle, the indirect effects we're not trying to capture. So that effect that's 2, 3, 4 steps down the line, we're not trying to deal with that. We're dealing with things that are directly impacted by the change. So say FIFO to average cost, that's directly affecting inventory. There's no question about that. But you're not going to get into sales and pricing and all those other stuff. So it's important to make sure that you are clear about what actually changes. So sometimes to go back, it is not practical to the reader, to the company to go back because they cannot determine the impact of the change, right? Sometimes things happen like to go back, your systems were manual and now it's automated, and to go in a file and go look for that transaction and all the things, that just ain't even make sense. It's not practical. So if you cannot do it, right, then the company has to report prospectively just in the future. All right. So they give us three conditions. One of these have to exist for us to be able to get out of doing retrospective, right? So it's always important where we have exceptions. What are exceptions? What do we have to be able to meet? So the 3 conditions we got to meet. One, like I said, if they cannot determine the effect of the change, right? If you apply it, you may not have the records, da da da. 2, if the assumptions about management's intent in a prior period. So that is something a little deeper, and you will be able, any of these, you have to actually document and demonstrate that you could prove that, right? 3rd, application requires significant estimates the company cannot develop. So say, and this is, inventory is a good example. If you're a food store and you change from one method to the next, because say you realize that in the past, the goods coming in first would go out first. So that's FIFO, first in, first out. And you realize nowadays, because of the flow, that don't make sense. You really LIFO, last in, first out. To talk about going through every product in your food store, that don't even make sense because you making estimates and you know, that don't make sense. So you have to really make an argument and apply it to make sure you're meeting one of these conditions. Just do it going forward, right? So the second type of change we have is a change in estimate. So some examples of changes in estimates are receivables, because for receivables, we estimate, okay, this amount ain't gonna pay this year. That's an estimate. We don't actually know. We are coming up with a number or percentage just based on our experience. So we estimate. Inventory obsolescence, that's also an estimate. We don't know if something is gonna be obsolete, we have an idea. So we say we have an inventory of iPhones. They come out with one every year. On average, every 5 years, it goes obsolete because they're not going to support an old one, right? You can't get parts. It don't make no sense even to sell it, right? So that inventory might be obsolete. So that's an estimate. We don't actually know. That could be a year, that could be 2 years. And right down the line, even depreciation methods, we may say, this equipment we bought to make t-shirts, this is supposed to last me 20 years, but really, it didn't last me 20 years because a year later, they have this newer machine and it could do all of that, plus give me twice the productivity, take up less space, and I could buy that old machine. I need to appreciate that now because that ain't no good to me, right? So things happen. So estimates are all of these items. These are just some examples. There are more. But anywhere where we have to make a guess, but it's what I would say, a guess that we have documented and we have support. So any changes in estimates now, accounting estimates, we deal with those prospectively. So we change it going forward. Right? So we don't go back for this one. We just account for the changes in the period of change, right? If the change affects that period, and then we just go forward. And we, of course, we have to disclose. So the reason that happens is that estimates are considered normal in terms of changes because FASB, as it says here, expects corrections, adjustments. As you live your life of your company, you may say my receivables, I think 10% will be uncollectible, but experience might tell you it really isn't 10%, it might only be 5%, right? So so FASB considers estimate changes normal, but they actually, and there's something to make sure you know, they prohibit you going back. So this one, the first one we did with principal, you go back. Estimates, they ban you from doing it. That's not even an option. You are not to go back to change anything. You just change it going forward. Okay. So there's this question, how do we differentiate between change in estimate and a change in principle? Because the argument could be made that, okay, I said that this is going to be obsolete in a year, and maybe that's an error because it really should be 5 years, but I was making an estimate. So normally, where you have this situation, the determination is that you consider the change as a change in estimate. If you have a doubt, you treat it as a change in estimate, and then, of course, you do it going forward. You make the change from now going forward. So whenever you're in that position where it's estimate or principle, and there's a question, then you have to do it going forward. So just for your information, when accountants do these type of things, we normally have to write a paper. And we normally have to say, we have taken this approach, and these are all the reasons why we have taken this approach. And based on this, this is how we're going to treat it, whether it's a principle or estimate, and this is the impact. And as of this date, this is what we're going to do. And we have it documented in that form so that if an external auditor comes, they could see this is the rationale. We didn't just willy-nilly, oh, I woke up one day and, okay, we should change our depreciation method or principle. And, okay, I won't just do it going forward. No, we have to say we are following the standard and what we need to do. So disclosures for estimates. So normally companies need not disclose changes in estimate because it's considered a normal part of the business. However, if it is material, then it's important to disclose the effect of that change on income from continuing operations and the per share calculation. So you could have, if you have a material, and when we talk about materiality, something that is so significant in the change, it could shift your income. So some companies could shift and it's like $1 million plus positive to income. And that you need to disclose when it's significant. Because you want the reader to know, okay, this is what you did. Just in case you might have been doing it for something untoward, they are clear about, okay, you shifted this method. I'm sorry, you changed this estimate and this was the impact of it. So the last change is change in reporting entity. So when we have this change, this is at the entity level. This is not a particular item on the balance sheet or income statement, but this at the entity level. So when we were talking about equity investments before, and we looked at if you have 10% interest versus 20 to 50% interest, and then if you have over 50% interest, you have to consolidate all the financial statements. If you have between 20 and 50 with no influence, then you are doing the equity method. So this is dealing primarily with that to say, if you had consolidated statements, because you had all the significant interest in all these subsidiaries, or you wholly owned, and something happened and you don't wholly own them anymore, you have to go back and individually report each one. Okay, because you change in the structure of the entity. So all along you're telling the public that we are this group, and now you're not that group anymore. Okay, so that changed what you are reporting at the entity level. So these are examples: presenting consolidated statements in place of individual ones, changing subsidiaries that constitute the group of companies. So if I had 4 subsidiaries, now I only have 2. Changing the companies included in combined statements. So some companies, they may have included 4 before, and they had 10, and now they decide to include 6 more, right? Changing from cost, equity, or consolidation method is also considered a change in reporting entity. So as I indicated, reported by changing the financial statements of all prior periods presented. So that ain't a light thing. If you go and change, you have to change, sorry, let me go back. You have to change all the prior periods. But most companies that are in this space, whereas reporting entity, they're maintaining individual financial statements anyway. So oftentimes this is not a big lift to say, okay, before we showed it all together, this group, now we changed the group. So we got to show it a different way, but we have to go back and redo all the prior periods. So again, for comparison basis, it's very important. Right? So the reader isn't thrown off and they say, oh, this company, this group of companies was 10 billion. Now this group of companies is 50 billion. And you just see in the total number and you go, oh, okay, I look in the notes. Oh, okay, the reason why they added 4 subsidiaries that weren't there before. Right? And they might have added them because maybe they have more interest in it or something like that. So they need to know. Right? So everything is always geared towards the reader. Are we fairly stating everything about this company, and does it make sense to the last year? Because we're looking at trends too. Are you growing? Are you contracting? What's happening? Because if they don't tell you, you'll be like, wow, they really doing well. And that might not be it at all. So the last group of items that we're going to look at is errors. And errors happen all the time. Doesn't matter, there's a lot of automation, errors still happen in the accounting. And some of the errors that occur that you see sometimes where you have a change to accounting principle and it's not acceptable, right? Mathematical mistakes, so that of course is very common. Transposition errors, you have 20, you should have 62 and you put 26, right? Changes in estimates, because the company did not prepare the statements in good faith. So really, I translate that to fraudulent behavior, where something is not done in good faith, right? So I said I can have my bad debt or the amount of clients that I think I'm not gonna be able to collect from, I say is 1%, when really it's 20. Because experience tell me it's 20, but I put 1 because I don't wanna write off 20% worth, right? And companies do it, they try and push the envelope, if you don't check it, it's gonna happen. But, again, you have to always be acting in good faith. Oversight failure to accrue or defer certain expenses and revenues. So auditors do this test at the end of the year to make sure you booked all your entries. They'll ask to see your bank statement for January if you have a December year end, and they'll want to look at your general ledger for January, February, and March. We call this the subsequent events testing to make sure that if you were supposed to accrue some payables and some things at the end of December, we could tell, because if you paid a bill January 5th, that should have been in your books in December, because that didn't just come up, right? So sometimes that's where you get an error, and if they fail to accrue it, then we make them accrue it. No, you gotta go back, go restate it, because it's material. Misuse of facts. So here, you get information, you apply it incorrectly, and that causes errors, right? So if someone tell me, oh, I had all these expenses and this fixed asset, and I look at the expenses and they just repairs and maintenance, then hey, take that out of fixed assets, that should be expense. People do all kinds of things to make income look good, because normally bonus and compensation is tied to income. So even in the financial statements now, executives in group, not individually, their pay is also disclosed in a note. So you could see how much of their compensation is tied to performance, right? Because it's a big problem. This is why Enron, all them things happen. People say it's errors, some errors to me are fraud. Right? Incorrect classification. So if I classify something as expense when it should be an asset, or vice versa, but if I put it in the wrong accounts, then I could have those type of errors. So we have these errors, and what do we do with them? So this is a nice little table that tells us, this thing. So this table tells us for each type of accounting category where the errors, and there's a description of what could happen. Normally you have to restate, okay? Where you have errors, if they're material, you gotta restate it. So expenses, recording them in correct period or incorrect amount, so that could happen. Misclassification, so short or long-term items. Equity, you could have improper accounting for earnings per share, warrants, other equity instruments. Long-lived assets, so we could have impairment, goodwill, other related items. So this is just one part of the list. You have other categories, all these are different categories, and again, restatement, meaning you gotta go back and restate the numbers. Show them as they should have been reported. Right. So inventory, valuation, quantity, cost of sales adjustments, taxes, incorrect tax provision, treatment of liabilities, other tax-related items. Right. So all material, that's why I keep using that word, all material errors must be corrected. Notice must is not optional, it's not if you feel like it, they must be corrected. And If they are from prior periods, you have to adjust retained earnings in the current period. And we call them prior period adjustments. And if you have comparative statements, so if I have statements that I normally give to you that shows the prior year, 2020, 2019, 2019, 2018, then I have to restate that prior statement and show the impact. Okay. So errors are very serious. And this is, the company should make adjustments to correct the statements for all periods reported, restate the data to the correct basis for each year, show a catch-up adjustment as a prior period adjustment. And if I go back to that, so data activities and just sometimes we see these things and we think they don't happen in real life. We have examples right in our space. A number of years ago, there was a serious error that was made, Family Guardian financial statements that were published on the 6th, and they had to go back and restate it and fix it. And it was very significant, and they fired 2 people, including the CFO. So this stuff could be damaging, especially if you publish statements on exchange, because you have to go back and you gotta reissue it. And it's very embarrassing because you have to have a statement to say what happened and why what you had on before was incorrect. So they're saying a play area because people get concerned if you make errors of that nature, because I have money in this place and what you doing? Because if that's one thing that was found, it might be other things, because the same people have responsibility, right? So this is real stuff that happens. So this is a summary, right? So like I said, at the end of the section, there's a nice little summary, and there's a summary of accounting changes and changes and errors. And this tells you what the approach that should be for changes in accounting principle. Like we said before, you go back. If it's not practical, then they tell you what to do in terms of you don't change your prior income and you disclose the effect in the current year and going forward. And then the other key piece that I didn't mention, you have to say the reason why you couldn't go back. You have to disclose that as well. So you can't just say, oh, I can't go back because I don't have the data. You gotta disclose that, why you haven't provided it. Changes in estimates, of course, current and prospective approach, as we said, and there's no adjustment to opening balance effects because this is considered a normal part of business. Changes reporting entity, so that's retrospective, so you got to go back and you have to restate, right? And you have to disclose and you have changed the impact on your income and earnings per share. Errors, you have to restate, right? When you have errors, you have to correct all the prior period statements. And then for the current statement, you have to restate the opening retained earnings, right? And the first period presented where the error effects occurred. So that's a lot. So imagine if you made a mistake and you realize that the error went back 5 years, you have to go for those 5 years and fix it, reissue. And then for the current year, you show the cumulative impact. So motivations to change. So when people do these things, sometimes it's not for the right reasons. Changing accounting method. So maybe because political costs, capital structure, bonus payments, smoothing earnings. So smoothing earnings is not a good reason. I don't really like that reason. Politics shouldn't be it either. But what I would throw in politics is sometimes you see a tax thing coming and you're trying to prep your statements. And sometimes if you know, normally when taxes are coming down the line, they'll have draft documents, they'll have things they circulate. This happens in the US all the time. And they'll say this type of investment or these type of things are going to attract more income, or sorry, more tax. And depending on the accounting method you use, you could actually attract more tax earlier than later. So sometimes, and I put that under political reasoning, you sit and you say, what is going to be the impact? Should we stay with this method because this method is going to hurt us in the long run? And they make adjustments on that basis. Also, capital structure. This happened with back in the Bahamas. There were companies that had entities under them. And what they found is that the government was double dipping because they'll say, I'm charging you VAT at the top, and the one underneath I charge in VAT. And they didn't allow for the fact that the underneath was rolling up to the top. Right? They wasn't focused on that. So some companies restructured in a way that they couldn't get double dipped by the government. Right? So that structure is also important in terms of if you set it up as and so capital structure, if you have consolidated statements or individual statements, all that matters. So the entity that is being dealt with. And of course, bonus payments. So that shouldn't be a reason, but people, switch methods because it helps their bonus costs, especially if they know they're not going to be there a long time. They get their money up front, and then they figure it out at the end when most of the expenses going to be hitting the books. So errors. So we have this concept, counterbalancing errors versus non-counterbalancing errors. So these two terms is important for you to know what they mean. So error could happen this year, and the books close, and you can't really go back. Well, you could go back, but you'll have to restate. So where you have this counterbalancing error, you don't necessarily adjust the statements because the next period is going to reverse naturally. Right? So there's some types of transactions that are going to reverse naturally, like say inventory and cost of goods sold. If you turn it over inventory enough and you made a mistake, it's going to wash out, right? Because that inventory ending going to be cost of sales, and it's going to come out and it's going to net out, right? But some don't, right? So here where we have the counterbalancing where it'll wash by the next, and they say will offset or correct it over 2 periods. So they specify, right? So you can't say, oh, it's going to correct in 10 periods, 2 periods, right? Here, if the error is already counterbalanced, no entry is required. 2, if the error is not yet counterbalanced, you make an entry to adjust the present balance retained earnings. So for comparative purposes, you may need to restate, right? Even if a correcting journal is not required. So here, if it's already counterbalanced, you don't need to do any adjustment for it. But of course, I always tell people document the hell out of these things, because then you could say your rationale for not touching it. So if a company has not closed its books, if the error is already counterbalanced, no entry is required. If the error is not yet counterbalanced, you have to make an entry to adjust the present balance. So they are all the things that you need to do. So now counterbalancing errors. These are the ones that do not correct in the next accounting period. And you must, that's the key word, you must make adjusting entries even if the books are closed. So that's a must. That's not a, if I feel like it, I must. And we don't use those words often, so that's a big word in accounting. So that was chapter 22. So errors and changes. Right? So when you do your review, when you deal with those questions, they will assist you in review. And then I'll just send you some multiple choice to um, practice so you could see if you have the concepts. Okay. So the second thing we're going to look at today is statement of cash flows. So this chapter 23. So in other accounting classes, I assume you would have done this before. Yes, no, yeah. Okay. Do you like cash flow statement?
Okay, we didn't give it much attention.
No? Okay. Most accountants, not most, but a lot don't like it because it's not simple. It's not necessarily the easiest one to do. You really have to understand a transaction, all the pieces to it. So in chapter 23, and this is just a preview, so when you read it, there's some of the things that it covers. You know, why we have the cash flow statement, why is it useful, how does it classify different types of cash flows, and then the format of the statement. It also has an example, an illustration that they walk through of an actual statement, and then it talks about the direct method of preparing it, right? In accounting, we use the indirect method. That's a dominant method. I think people are moving away from the direct, probably only in the US. And this book is US book, so US GAAP. I think they're the only one that allow a choice. But if you do IFRS, which is international standard, it is the indirect method. So some special problems. So the chapter also talks about some things, challenges we have with preparing the statement, and then lastly, use of a worksheet. I've never actually used the worksheet to do a cash flow, so but some persons do. So just get into some of the bare bones. Statement of cash flow. So what the cash flow does is give us information about how we're using cash. That's really what it is. How did we use cash for the period? So if the period is for the year, how did we use that cash that we got in? The second objective is to give information specific about the areas of cash use in operations. So how do we use it in operations? How do we use it in investing activities? And then how did we use it in financing activities? So you're in this company, cash coming in and cash coming out. You want to know what we're doing with it. Because some companies on paper are saying they make $80 million. But when you go to their bank account, much cash. So you gotta know what you're doing with the cash, right? Because you want to understand what's happening. So it gives us information. I love to look at the cash flow statement even beyond income and balance sheet. I like to look at the cash flow first, actually, because it tells me if you could even generate cash flow. Some companies can't pay dividends, and sometimes they're not meeting their obligations, although they have multi-locations and have all these assets. Like women say, you could be land rich and cash poor. That could tell the story right there. And then it shows you the difference between what you report as net income and then what the real cash income is. That's what I call it, real cash income. And then it tells you about non-cash activities as well. So you could see what's happening in cash, and then there's some things that are non-cash related that are also happening too, and it gives you an idea of the scope of that. So the classification. So the first part of the cash flow statement is operating. So really that focuses on the income statement items. Right? So whatever's so you start off using the indirect method, you start up with net income and you have some adjustments. The other things that fall under this operating activities is not on the slide, but what falls under there is the current assets and current liability changes. Right, so any changes in current assets and current liabilities will be in this section, operating activities. Because really that's the operations of the company, that's the heartbeat right there. The second area for the cash flow statement is the investing section. So investing is any changes in investments, which is the asset account, our long-term assets items. So that's changes in fixed assets, intangibles, and any other long-term asset. So they go in investing activities. Because this is how you're using your cash to invest in more equipment, in land, or if you have investments that are like some companies will buy land. I said a company that did this. They bought land because they knew that down the road they were going to build another location, say in Carmichael, so that they already have a couple spots. They have the land. They're not ready to do it yet, but it's a long-term investment because they want to put more locations. So they're ready preparing the different places, and they just waiting for certain population size. So that's an investing activity because they looking long-term. The third section is financing activities. So changes in long-term liabilities and stockholders' equity, right? So in the financing section, when we look at a balance sheet, this focuses on changes in mortgage, bonds payable, any long-term debt, as well as changes in stockholders' equity. So that's dividends, that's issuing shares and stock, that's buying treasury stock back. So that's the focus there, right? So cash and cash equivalents. It's also important to know what this is. It's cash equivalent just don't mean hard cash in the bank. So FASB gives us a definition of cash equivalent. So short-term, highly liquid investments that are both readily convertible to cash, right? Or so near their maturity that they present insignificant risk of interest rates, changes in interest rates, okay? So they have here generally only investments with original maturities of less than 3 months qualify under this definition. So I want us to do an exercise from the text because this is going to help us to determine if we're clear about which sections and where things go. So question 17, I'm going to switch to text. Let me make sure I got it up. I don't know if I put it up. This is question 17. So while I'm going to the question, any questions so far? Do you have errors at work that y'all have to deal with? Or changes? Or y'all didn't hear about it? Every place I've been, that's something happen. Everybody don't know it happen. Things happen. Sometimes, especially in banks, say someone did some incorrectly to someone's account, you got to deal with it. And sometimes that dealing with is you got to correct it, and it might be a loss, and you have to change what you report in your financial statements if it's significant. So if you have, and this happened somewhere where I was, and they, I think they put the wrong rate in the system, and it was a global error, but they couldn't take it away from the clients. So in fixing it, they had to take the hit. And so they had to, because they debated whether we can take it from the clients and then advise them. And then there was no, they had to just show, let the clients have it, show the error, and then move on. But stuff like that happens where
We
you,
had a glitch in our system.
mm-hmm,
You know, like our legal fees didn't come off the credit cards. So they did it, they just took it off for 2 years the next year.
Jesus. So they tell clients that.
Yeah, they told them that.
See, stuff like that. Ugh. They should have eaten it though.
You should have.
Because, see, our clients in the Bahamas don't push back. But in other countries, oh, hell would pay. Hell would pay. So this 17. So brief exercise. Okay, chapter 23 and 22. Yeah, that's, see, stuff like that. I'd be like, the little man always get a little shafted because they don't know. But I tell people things happen all the time.
Something looked like another lady was trying to get into his loan box. She's probably already gone. It was something.
Oh, okay. They just told me it was one, so I wasn't even close to it to add, but I think Miguel could add people as a, okay, that's question for me. Technology, okay, this, keep it in the right place.
The sheet you were reading from, is that the same as the slides on the screen? The sheet you got.
Yeah.
Can I scan it?
I can email it to everybody.
Oh, okay.
Yeah, I can send you all the slides. No, I normally, oh, jeez, just trying to get to the question. Yeah, I gonna send the slides. Well, I sit down here before I leave, I'll add it to the thing so you have it. I don't know why this ain't cooperating with me today. Trying to get to the question. I just want to do one. Okay, this is 19. So this should be 20. It should be 20. All right, if I don't get it this time, we can keep it moving because I can hold up the class for this. Yeah, we're gonna skip that one. I wanted to do one of the questions, so we'll skip that. I'll just have it ready for the next class at the beginning. We could do a review. So let me go back to take the this we will window. Okay. So we will do this in the next class. I'll go over those questions in particular. Just as a review at the beginning of the next class. Okay, so we'll still do those. So under the cash flow method, statement of cash flows, the format is normally we have the operating activity section, investing, and financing. For the operating section, there are two methods that are available, direct and indirect method. The dominant method that is used is the indirect method. Normally, accounting students have to learn both just to know what they are. But these are the three main areas. So this is an example. This is an illustration of one where we have statement of cash flows. And so here you have the sections. So there's the operating section here, investing section here, financing, and then the change in cash. So this line here adds these three totals. So cash flow from operating activities, cash flow by investing, cash flow financing. Those three added together will give you your net increase or decrease in cash. And then you have your cash at the beginning of the year, which you take straight off your balance sheet, and cash at the end of the year, which this should balance to your ending balance on the balance sheet. So I normally tell students these three numbers, they are given. This number is my control total I should always come back to. So this way most of the work is done, and this probably is the most difficult section because you have to analyze the most accounts there. So when we actually have to prepare a statement, we have three sources of information that we use. The comparative balance sheet. So we need balance sheet for 2 years. The year that we doing the statement of cash flow for. So we doing 2022, we need the 2022 balance sheet, and we need the prior year, right? So 2021. We need the current income statement as well, and we need selected transaction data. So certain transactions we need to understand. We need to get some data that may not be on one of those statements, and it goes a little deeper. So things like gains and losses, if they sold an asset, you need to know how much the details behind that. So normally for the purpose of teaching courses and going over the cash flow, they give you the data. That wouldn't be something that you would just have just looking at those statements. In practice, we would get the general ledger and we'll go through certain accounts, like all the fixed asset accounts you go through in detail to make sure you don't miss anything. So in the textbook, it talks about 3 steps. I have 5, right? So I always set up the structure or the frame. So that's like what you saw on that slide. That just tells you where what goes in each bucket, right? So I always like to start off and have title, write down each section. This is the section, the subtotal, this section, the subtotal, beginning, ending, balance, so that I always have the frame and I just drop in numbers and things in the right buckets. So the first part, they start off with determine the change in cash. That's the bottom piece, right? So that's where they say start first, and I agree with that. Determine the net cash flow from operating. So you start with after the cash at the bottom. The operating is the first section, right? Then investing, then financing. And then lastly, 5 I added as well. it's important to determine if there are any non-cash items to disclose. Because although the cash flow statement is just cash, at the bottom of it, you normally put a note to indicate if there were any non-cash items. So for example, if I issued shares for land, that's a non-cash item because no cash passed. I should have a disclosure, no disclosure to say that, right? So I'm also accounting for non-cash items, not in the body of the statement, but as part of the presentation. So they have an example here. I'm not going to go into the example in the details, but I want just for the format so you can see what the format looks like. So I'm not going to focus so much on what the details say. So I'm going to skip that part. This is so tiny. So what this is just showing here is the first thing, the sources of information. So you start to do cash flow and you gather. So this additional information, this is the income statement, right? And then this is the comparative balance sheet. This balance sheet has current year, prior year, and this is the change, right? So when you see the slides, that's what it'll be showing you, okay? So change in cash, right? So we have cash here. This particular company didn't have anything in 2019 because they just started it in 2019, January 1. So January 1, they had zero balance. So their change in cash is $49,000. So if I was doing the cash statement, I'll have beginning cash is what, zero, right? And then my ending cash should be $49,000. So my increase or decrease coming out those three sections should be $49,000. So that's one section, you tick off, finish. Right? So the next thing is to determine the cash flow from operating activities, right? So normally cash flow from operating focuses on net income and current liabilities and current assets. So here, and this is the indirect method, you have net income because this is now cash flow provided by operating activities. So you have net income, you adjust it, adjustments to reconcile net income to net cash provided by operating activities. So the goal of this is to say this net income on accrual basis, we can convert it to net income on a cash basis. That's what this really doing. So I'm analyzing my net income first. So this one is simple, just don't have depreciation. Depreciation is a non-cash item. So I'm going to adjust it for everything that didn't involve cash. So I look at my receivables, I look at my payables, any changes in any of the current assets, current liabilities, and I look at my net income statement to see if I have any items, right? So there's another slide that gives you all the things that could be added or subtracted, which I really like. So then we get our net cash provided by operating activities. So investing and financing. So remember I said investing and financing is fixed assets and investments account. So when I look at this, do I have any of those accounts? No, right? So that means that section you wouldn't see on this cash flow statement. And that's fine, right? So here we have the first part that we spoke about, provided by operating activities. Notice there's no investing section because they didn't have any. And then we had cash flows from financing. So this is, they issued stock because that's how they started the company, and they paid dividends. So this was the additional information. So that's the financing, because this section is just dealing with equity and long-term debt financing. Because what they're saying, how do we use cash to finance our operations? Did we borrow money? Did we issue stocks? Right? Did we buy back treasury shares? This is all focusing on how we finance in our business. That's why I really like this statement. And then you have, like I said, the increase. So remember that 49,000? Our beginning balance was zero. And then our ending should be 49,000 at Agreed start December. Okay, so they go to year 2, which I don't need to go to. So I like this slide. It's not easy to read from here, but you'll see it when I circulate it. It is good because for that first section, that operating activities, cash flow from operating activities, it tells you all the things that you should add and all the things that you should subtract. Okay? So when you take in net income that's reported, this tells you anything that should be added to that number, any increases or decreases here, increase in accounts payable, increase in accrued liabilities, income, increase in deferred income tax liability, and then it tells you the deduction. So I really like this because just give it to you all in one snap for that section. Good little guide. So just closing this out, these are some of the things that we also have to think about, some problems that we could have when we doing cash flow statement, adjustments that might happen to net income, accounts receivable, when it's reported in net, other working capital changes. Sometimes we have losses, and then sometimes we have significant non-cash transactions. Well, did I come right out? Tell me it came out of my meeting. Okay, great. Okay. So this is talking about, like I said, items to adjust to net income. So in that list that you saw on that one table, all these would be listed as well, right? Depreciation, amortization, to say non-cash, right? We spend that money up front to buy it. We just allocating the cost over a period. Post-retirement benefit costs, there's another item to adjust to net income. Changes in deferred tax, equity method accounting. So they all adjustments, loss and gains, right? So they go through the details of what those are. Stock options, okay? Cash is not affected by recording this particular type of expense. Unusual and frequent items, right? So significant non-cash transactions. So sometimes you have transactions that are significant that are non-cash. And this might be if I buy an asset and I assume a liability, or I issue equity for it. So I buy land and I just issue stock. I don't use cash. Refinancing long-term debt. So I had debt. So instead of paying it off, I refinanced it. That didn't involve any additional cash. So these are all non-cash, significant non-cash transactions. So I have homework for chapter 22 and 23. Like I said, I put it on the classroom so you'll see it, as well as chapter 24. So next class, the questions I wanted just to roll over, just to run through, we'll do it at the beginning of the next class. So that should be us for today. Are there any questions? So next class is just chapter 24, and then we'll have our final.
Do we have a review class also?
Well, next class I want to spend time reviewing, so I'm not all going to do chapter 24. So part of our class, half will be 24, and the other half will be review. So I'll do like a recap of where we came from and all of that. Any questions, Cyberland?
No questions. Thank you.
Tanika, any questions?
No, no
Okay.
questions. Mhm.
I'm gonna upload slides right now while I'm sitting here, and so you should have it as well in the classroom.
Okay, thank you.
Okay. And this should be recorded. I still record this on. So see you all next Saturday.
Okay, bye-bye.